If you're looking for a commercial property that needs work or a quick closing, bridge financing could be exactly what you're looking for, specifically a bridge loan from a private lender. Hi, my name is Jason Balin from Hard Money Bankers. In 2007, my business partner, Chris Haddon, and I started this private lending operation, and we've lent over 4,000 projects, mostly commercial, some investment residential. And I want to go through today exactly from the lender's side how we set up bridge financing on commercial buildings. There's a humongous need in the marketplace because if you're a commercial property owner, you know that dealing with banks is a real pain in the neck. It's just not a great option. Now, if you have a building that's 10, 20, 30 million dollars, maybe a bank's a little bit easier to deal with, but there's a huge gap, especially in small balance commercial buildings, anywhere between, a few $100,000 and a few $1 million. And that's where private lenders, really come in and serve a purpose. And it's something called bridge financing, bridge loans. In essence, you're bridging the gap between the current situation and then long-term financing. Obviously, banks serve a purpose for longer-term deals because they have cheaper interest rates. But if you need some sort of shorter-term loan or a bridge loan, a private lender is really a good option. It might end up being a little bit more expensive than bank rates, but they have significantly more flexibility. And if you've ever kind of gone down that route of SBA financing or bank or credit union financing for a commercial building, you know what I'm talking about. Like, it's not easy. It takes a long period of time, and you got to put a lot of heavy lifting and financials in place where working with a private lender is just not that case. So let's talk about how commercial loans work. What's underwriting a private lender looks at. Some of the docs that they need, some of the asset types, and things like that. So a commercial private loan is a collateral based loan, and the lender will put a first mortgage for the most part on your commercial building. So it's either could be a purchase or it could be a refinance if you have a commercial building. Now, typically, the terms of the loan usually between 1 year, maybe 2 years, maybe if you're lucky, even 3 years. But the interest rates are usually double-digit interest rates, 12, 13, 14%, things like that. And that works great in short periods of time, but it doesn't work great if you need the loan for a long period of time, right? So the goal is to bridge the gap until you can get permanent financing. Maybe you have to get the property stabilized, and then the bank, will refinance it. But the good part is these private lenders, you can get this thing closed in a matter of 2 weeks, call it, and get the property, you know, you know, get the property in your hands if you're purchasing it, or get the cash out if it's a refinance to keep moving on and keep moving the project. So because these private lenders have so much more flexibility and they can move so much quicker, most commercial property owners want to go with a private lender first so they can get everything under wraps, and then they have time to get bank funding as needed. And again, they can be vacant buildings or occupied buildings or non-performing buildings. You know that going to a bank to get a vacant loan on a commercial property just is very hard to do. Or if it's not performing, it's very hard to do. These private lenders, they're collateral-based lenders first. So they just care about that. So the private lender's underwriting kind of looks like that. Now, the collateral is the most important part. Typically, they'll lend up to 50% or so of the value of the property. And again, it can be vacant. We do loans on vacant buildings every month. And, there's no income coming in on them. And those are hard to get bank financing for. So, we'll do those first as a private lender. We'll do the vacant. And then after it gets stabilized, then the borrower, the commercial real estate owner, will refinance out of our loan in order to get long-term bank financing at cheaper rates. So the collateral's first, the borrower's second. Listen, if you're lending somebody money, you gotta think about this in the lender's shoes. If you're lending somebody money, you want them to be polished and professional and have a game plan in play to pay you back, right? If they don't know what they're doing on their project, chances are the lender probably doesn't want to mess with them. So credit score, listen, higher credit the better. We all get that. But credit paints a picture. It doesn't necessarily disqualify somebody from not getting a loan. We do loans with lower credit borrowers all the time, but they still have good characteristics in order to want to lend to them, right? They might have got into a financial situation or something happened, but they just don't pay their bills just because they don't want to pay their bills. So credit does tell a story, which is important. Another thing that lenders do is, they typically base things off the sales approach, not the income approach. Because if you're basing it off an income approach on a vacant building, you'll never get approved for anything. Or if you have under market value rent, you're never going to get approved for what you want. So they're more creative, outside the box. Look at the sales approach, or maybe they'll look at a pro forma income approach as well. That's typically important. Some of them look at replacement value. Docs that are needed is they will do some sort of valuation. They will go out to the property, they'll inspect it, make sure the property exists and is similar square footage as stated. And the one key thing that a lot of real estate investors and commercial property owners like is they don't have to do a full phase 1 and phase 2 environmental study that could take weeks, and typically don't have to do full alta surveys that take a long period of time and are expensive. Yes, they do due diligence, though. They do environmentals. We use something called like a loan check, and it only costs a few $100s instead of a few $1,000s, and it only takes 3 days instead of 3 weeks. And in essence, it determines if the property type and the location have any red flags for environmental concerns. Now, if the commercial building is a gas station or laundromat or something that does, it might get elevated to an enhanced desk review, which is still cheaper and quicker than a full phase 1. And on some of the properties, full transparency, we will have to do a full phase 1 if it's of a high risk. But most of them, most of the properties that we'll look at, 80+% of them pass with just a loan check. So that just saves time and money. There's not lots and lots of, personal financials and everything else. This is a collateral based loan to good, solid, commercial property owners. That's that important part. And most asset types work. Obviously some private lenders have their preference of areas and the assets that they want to do. Some don't want to do heavy industrial. Some are scared of office. We like doing office. We think there's an opportunity in office, doing loans on offices and retail and mixed use and things like that. So it is important to talk to your private lender to see what assets they like, what areas they like in. There's states that we lend in and there's states that we don't lend in. So it's important to obviously talk to the lender to see what makes the most sense. And probably most importantly is having a solid exit strategy. It's very important, but it's also challenging. So you got to be realistic. If you have a low credit score, you're probably not going to refinance with a bank. So your exit strategy is going to have to be after you perform on the project to probably sell it, because you probably won't get a bank loan if the credit score isn't high enough. So that's an important thing to know, is realistic. I mean, it's hard to get bank money on some of these deals. SBA loans take a long period of time to get. They're out there. I know that because we do commercial loans every day, every week, every month. And I don't want to say every day, every month, I should say. We do multiple loans every month on commercial properties, and everyone thinks they can refinance these things quickly, and they don't happen. Most of our loans stay on our books longer than the real estate investor would like to. So you got to make sure you have contingency and you have budget for the payment if it does go over. So you got to be realistic. But I do believe at the right LTV, at the right financials, banks still do want these loans on their portfolios. So there are exit strategies involved. Yeah, so that's that. Hopefully you learned a little bit about how private lenders analyze and review commercial properties. If you need my help with a commercial property you're working on, it might be a purchase, it might be a refinance, you might need a construction component on it, I'm happy to help. I talk to commercial property owners all the time. A lot of stuff we specialize in is the small balance commercial stuff, a few $100,000 to a few $1 million. That typically works. That can support the interest rate that we charge for these. And there's a huge, need for them. And not many lenders, are able to help in that type of loan product. So again, my name is Jason at Hard Money Bankers. If you have any questions related to this topic, just comment below this video. I'm happy to answer them personally. This is what I do every day, and look forward to seeing you in the next video. And if you need anything, reach out to me at hardmoneybankers.com.